Usually, when we talk about the future of healthcare, the conversation just goes straight to the clinical miracles.
Oh, absolutely. It's always about the bedside tech.
Exactly.
Yeah.
I mean, we picture gleaming new technology, AI diagnostics, robotic surgery, gene therapy.
Right. The stuff that makes the headlines.
Yeah, it's all about what happens right there with the patient.
Yeah.
But buried inside the sources we're looking at today for this deep dive is a statistic from the Congressional Budget Office.
And it is a grim one.
It paints a much darker, a much more urgent picture of the reality surrounding that hospital bed. Because back in 2011, about 27% of hospitals were operating with negative margins.
Which means they were losing money every single day.
Right. And the CBO projected that absent major systemic improvements in efficiency, that number would hit a staggering 60% by 2025.
It completely reframes the entire conversation around healthcare leadership, honestly. I mean, a 60% negative margin rate.
It's just wild to think about.
It means that more than half of all hospitals are essentially bleeding money. They're unable to sustain themselves.
So we're talking about, what, 6 out of 10 hospitals facing the brink of collapse?
Basically, yes. It forces this really harsh realization that it is no longer just about your ability to deliver the absolute best patient care.
Right. Because if the hospital doesn't exist...
Exactly. It's about whether the doors of the facility can even stay open to provide a place for that care to happen in the first place.
Because when a hospital bleeds money, the consequences are visceral.
Wards close down.
Older equipment doesn't get repaired, and, the community just loses its safety net entirely.
And that harsh reality is the entire reason we are doing this deep dive today.
Exactly. And we're looking directly at you, the listener, right now.
Yes.
Let's say you are a doctor of nursing practice, a DMP, stepping into a new leadership role.
You've got a clinical need. You want to secure like a state-of-the-art fetal monitor for your maternity ward.
Or maybe you're just someone who's, insanely curious about how massive, highly complex organizations actually manage to keep the lights on.
Either way, you really have to bridge the gap between clinical necessity and business reality.
And today, we're going to arm you with the exact language to do that. We're going to break down the big macro financial statements to see how a hospital's health is actually tracked.
We will uncover the hidden performance metrics, kind of like the cheat codes that executives use to judge a department's efficiency.
Oh, I love the cheat codes part. And finally, we will crack open the mathematical models they use to look at your proposal and say, yes or no to your funding.
Because here's the thing, if you don't speak their language, you just cannot participate in the conversation.
You're just totally shut out.
Completely. When you sit at a boardroom table with senior financial executives, you have to understand the specific mechanisms they use to view those key decisions.
Your ability to get what your clinical department desperately needs. It really hinges entirely on your ability to interpret those financial realities, right?
Right. You have to translate your clinical requests into their business metrics. You basically have to prove the value of your clinical needs mathematically.
So let's start with the foundation then, the language of the ledger itself. Everything in the financial world seems to be built on something called GAAP.
GAAP.
Yeah, generally accepted accounting principles. Now, my immediate assumption when I hear, accounting principles is that this is some rigid, unbreakable federal law monitored by people in suits with calculators.
That's a super common misconception.
But the sources draw a very clear line here.
Yeah.
GAAP is not a law at all.
It's really not. GAAP is an evolving, living set of standards, principles, and practices that guide how financial statements are constructed.
So the government isn't writing this?
No, the U.S. government deliberately steps back. They don't set these standards directly.
Huh. Why is that?
The prevailing belief is that the private sector is actually closer to the ground. They have the resources, the knowledge, the daily exposure to figure out what financial reporting practices actually work best in the real world.
Okay, but if the government isn't writing the rules, who is? Someone has to be telling a massive hospital system how to report their millions of dollars in revenue.
Well, it depends on what kind of hospital system you were talking about.
Oh, so there are different versions.
Exactly. The dialects of this language, they change depending on your region of the healthcare universe. For publicly traded, for-profit companies, the SEC requires that GAAP is followed.
The Securities and Exchange Commission, right?
Right, but they hand the actual standard-setting power to a private group called the Financial Accounting Standards Board, or FASB.
Okay, so FASB handles the private sector. But healthcare is this massive, messy mix of public, private, and government entities.
Which is exactly why the rules have to adapt. If you're looking at a local or state government hospital, say, a large county trauma center, their GAAP is determined by the Governmental Accounting Standards Board.
GASB.
Yep, GASB. And they operate under fundamentally different assumptions than a private enterprise.
Because their funding is different, right? Like taxpayers and municipal bonds.
Exactly. Their funding mechanisms and taxpayer obligations are completely different. And then, if you're dealing with a federal entity like a VA hospital, they are regulated by the Federal Accounting Standards Advisory Board.
So FASB, that is a lot of acronyms. FASB, GASB, FASB.
That's it.
But why go through all the trouble of standardizing this across different boards if it isn't strict law?
Well, think about the alternative.
Why not let every hospital just track their money however they want to?
Imagine you are an investor or a governing board member or even just a nurse leader trying to compare your hospital's financial health to a competitor across town. If Hospital A tracks their revenue the second a patient is billed, and Hospital B tracks their revenue only when the cash actually clears the bank, you can't compare them.
Oh, because you're looking at two totally different realities.
Exactly. GAAP provides a universal baseline. It creates a structure so you can actually compare apples to apples.
That makes sense.
But because it is a set of principles and not rigid law, it leaves breathing room. The exact format and the, granular details of the financial statements can still vary based on the specific expert interpretation of a chief financial officer.
I like to think of it like they give you the boundaries of the sandbox, but the CFO gets to decide the architecture of the sandcastle.
That is a great way to put it.
And what they're building inside that sandbox are the three basic financial statements, the big three.
The statement of financial position, the statement of comprehensive income, and the statement of cash flows.
Right. And the most helpful way for me to wrap my head around these when I was reading the sources was looking at their relationship with time.
Time is the absolute crucial variable here.
Because they aren't telling you the same story. Because they exist in different temporal states, right? Think about it like this.
Okay.
The statement of financial position, which pretty much everyone just calls the balance sheet, is a photograph.
Yes.
It's a static, frozen snapshot taken at one exact given moment in time.
Yeah.
Like midnight on December 31st. Flash. That is what you look like.
A perfect snapshot.
But the statement of comprehensive income, the P&L, is a video. It measures movement and activity over a period of time, like watching a runner over the course of a whole year.
Right, because you need both to know if the hospital is just holding a really good pose for the camera or if it is actually running forward in reality.
Exactly. The photograph might show a perfectly healthy athlete at the starting block, but the video reveals they tripped and fell 10 yards into the race.
You really cannot understand the overall health of an organization without looking at both.
And to complete that analogy, that third statement, the cash flow statement, that's kind of like the oxygen monitor the athlete wears while running the race.
That's a brilliant way to phrase it, because it tracks the actual, literal cash moving in and out of the lungs of the organization during that exact same period.
So when someone hands our listener a stack of financial reports, they aren't just staring at a wall of intimidating numbers anymore.
No, they're holding a photograph, a video, and an oxygen monitor.
Right. So let's pick up the photograph first. Let's look at the balance sheet and break down exactly what it reveals about a healthcare organization at a complete standstill.
Well, the entire balance sheet balances on one foundational equation.
Which is?
Assets equal liabilities plus owner's equity.
Okay, let's translate that out of accountant speak for a second.
Sure. Assets are simply the total resources owned by the organization. It's literally everything of value that you have.
Okay, simple enough.
Liabilities and equity represent the other side of the coin, which is how you acquired those assets. Liabilities are what you borrowed. It is the money you owe to outside parties.
And equity.
Owner's equity is the capital that is actually owned free and clear by the institution. Now, because a massive portion of the healthcare world is not for profit, they don't have owners in the traditional sense.
Yeah, there are no shareholders.
Exactly. So instead of owner's equity, they just call it net assets. Net assets are whatever is left over when you take your total assets and subtract your liabilities.
Let me see if I have this right. If I buy a house for $500,000, the physical house is my asset.
Yes.
But if I took out a $400,000 mortgage from the bank, that mortgage is my liability. The $100,000 I actually put down in cash, my slice of the pie is my equity. Or, in hospital terms, My net assets.
That is the exact mechanism. Perfect.
Great. So let's zoom in on the assets side of that photograph first.
The balance sheet divides your resources into two main categories: current assets and fixed assets.
And current means short term. Right.
Yes, current assets are highly liquid. This is your cash on hand, the money you use to fund daily operations. It also includes cash equivalents. Basically anything that can theoretically be converted to cash within a one-year time frame.
Like accounts receivable. The money that insurance companies or patients owe the hospital for services that were already rendered.
Exactly. And here's a detail that often surprises clinical staff when they first learn this.
What's that?
Current assets also include your inventory. In a hospital setting, that means items sitting in supply closets like, dressings, linens, syringes, and pharmaceuticals.
It feels really strange to think of a closet full of bed sheets as a financial asset that just sits next to millions of dollars in cash on a balance sheet.
It does feel weird, but they represent tied-up capital. The hospital spent cash to acquire them.
Oh, I see.
And because they are expected to be consumed in the process of generating revenue within that single year, they qualify as current assets.
Okay, so what about fixed assets?
Fixed assets, on the other hand, are strictly long-term. These are resources that cannot and will not be converted to cash within a year. They are intended to serve the organization over a much longer horizon.
So these are the heavy hitters. The land the hospital sits on, the physical buildings, the heavy machinery, like those multi-million-dollar MRI machines.
Correct. But there is a very harsh reality of healthcare accounting that we really have to address when we talk about measuring these assets.
Especially regarding the money a hospital expects to bring in, right?
Yes. You cannot just look at the gross assets or the gross revenue from patient care and assume that is what the hospital is actually worth.
This was honestly one of the most eye-opening parts of the sources for me. Because if a hospital performs a procedure and the charge master says it costs $10,000, they don't actually put $10,000 on the balance sheet as expected cash, do they?
Absolutely not.
They aggressively shave chunks off that number just to find a realistic starting line.
They have to. You start with gross patient revenues, but you are legally required to apply mandatory deductions to find your actual expected net revenue.
And what are those deductions?
The sources identify three major deductions that basically wipe out revenue before it ever truly exists. The first is bad debt.
Bad debt.
Yeah, this is a provision for care that you provided. You fully expected to be paid for it, but the patient or the entity simply defaulted.
So you provided the service, you sent the bill, and they just ghosted you.
Exactly. They vanished. The second deduction is charitable allowances. This represents care provided to individuals who have limited resources and, crucially, are not expected to pay from the very start.
So it's a calculated provision for charity here.
Yeah.
You knew going in it was free.
Right. But the third deduction is usually the most massive, and it is entirely unique to the complex payer system of healthcare.
Which is?
The contractual allowance.
Let's pause on this because contractual allowances seem to dictate everything in hospital finance. This is the discount negotiated in advance with third-party payers, right?
Yes. Private insurance companies, Medicare, Medicaid.
So the hospital generates a bill that says this surgery cost $10,000. But the insurance company looks at their pre-negotiated contract and says, no, our agreed rate for this procedure is only $6,000.
That happens every single day.
But that $4,000 difference doesn't become bad debt. It doesn't become a lingering bill you send to collections. It just vanishes. It is legally wiped away by the contract.
It vanishes immediately into thin air. And as a financial leader, you have to deduct all three of those: the bad debt, the charity care, and those massive contractual allowances, just to figure out what your realistic revenue might actually be.
Wow. So only then do you have a true picture of your incoming assets.
Probably then.
Okay, so we have the asset side of the snapshot down. We know what we own and what we actually expect to collect. What about the liabilities? What the hospital owes to the rest of the world?
Liabilities are also split by that exact same one-year time boundary. Current liabilities are obligations owed within a year.
So that's the accounts payable, right?
Yeah.
The bills you owe your suppliers for those linens and pharmaceuticals we talked about earlier.
Yes. And it also includes the current upcoming portion of any long-term debt you have to pay this year.
Like the mortgage payments due in the next 12 months.
Exactly. Long-term liabilities are the massive debts that will take years or decades to clear. A 30-year mortgage on a new ambulatory care facility or municipal bonds the hospital issue to fund a new wing.
There is a specific line item in the sources regarding liabilities that every clinical leader really needs to internalize, though.
The human cost.
Yeah. The largest single liability for healthcare organizations is salaries. The human cost is just the heaviest weight on the board.
Because healthcare is fundamentally a service industry. You are not manufacturing cars on an assembly line. You are providing human-delivered care.
Right.
Your people are your primary resource, and therefore, their salaries and benefits will always be your primary recurring liability.
Okay, before we move off the balance sheet entirely, we really have to tackle the concept of depreciation.
Ah, depreciation.
Now, I know this is a topic that sounds like pure accountant drudgery, but the sources make it crystal clear that misunderstanding it can basically ruin a clinical leader's career.
It really can. It's a huge blind spot.
Because when a hospital buys a massive fixed asset, let's say a $2 million piece of imaging equipment, they don't just write a check and subtract $2 million from their profit that year, do they?
No, doing that would completely distort the financial snapshot we talked about.
How so?
Well, if you subtracted $2 million all in 1 month, it would look like the hospital had a catastrophic financial collapse, when in reality, they just bought a machine that will generate revenue for a decade.
Oh, that makes sense. It would skew the video.
Exactly. Instead, you account for that purchase through depreciation. Depreciation is a method of spreading the cost of an asset over its useful life to reflect the wear and tear anticipated with its use.
But how exactly does a hospital calculate that in real life?
The sources note that healthcare organizations typically use a straight-line method. You take the cost of the asset, subtract any salvage value it might have at the very end of its life, and simply divide it by the number of years you expect to use it.
Okay, so if that $2 million machine is expected to last 10 years, you just record a $200,000 depreciation expense on your books every single year.
Exactly. And it is vital to understand that this is a non-cash expense. You are not writing a literal check for $200,000 to anyone.
Right. You're not paying the depreciation monster.
Right. You are simply acknowledging on paper that your asset is losing a portion of its value every year as it gets closer to obsolescence.
But why does a doctor of nursing practice running a maternity ward need to care about the depreciation schedule of their equipment?
Yeah.
Like, why does that matter to them?
Because of what happens when you want to replace it.
Oh, okay. Walk me through that.
Imagine you are that DNP. You read an article about a brand new model of fetal monitors that has this incredible new predictive software. You go to the CFO and say, I need to upgrade my monitors right now.
Sounds reasonable.
But the CFO looks at the books and sees that your current monitors are only 3 years into a 7-year depreciation schedule.
Oh, so they still carry a massive book value on the financial statements.
Exactly. You haven't finished draining the value out of them yet. If you prematurely replace capital equipment before it has fully depreciated, you force the organization to take a sudden, significant write-down of those remaining asset values all at once.
So you basically take a massive, unexpected hit on the balance sheet.
Yes. You aren't just asking for the cash to buy the new monitors, you are forcing the CFO to blow a hole in their carefully constructed photograph for the old monitors. You are actively destroying their asset sheet.
Wow. So if you walk into a budget meeting demanding new equipment without acknowledging or even realizing that you're triggering a write-down event, the financial executives will immediately realize you do not understand the business reality of your request.
They lose your credibility before the negotiation even starts.
That is the exact translation of clinical need into business reality we talked about in the mission.
It's the perfect example.
So we've studied the photograph, we know how to read the balance sheet to see what the hospital owes, and how things lose value. Now, let's press play.
Time for the video.
Yeah, let's watch the video of how money actually moves through the system over time.
The video is the Statement of Comprehensive Income, commonly known as the Profit and Loss Statement, or just the P&L.
P&L, right.
This document summarizes all organizational revenue and expenses over a specific period of time. Usually, management looks at this monthly and then aggregates it annually.
This is basically the scoreboard. Like, did we win or lose this month? Did we make money or lose money?
To find out, you take your net revenue, which remember is that realistic number left over after all those contractual allowances and bad debt deductions we talked about.
The post-deduction reality check.
Right. And you subtract your operating expenses. This includes the salaries, the benefits, the medical supplies, the facility maintenance, and that non-cash depreciation expense we just outlined.
And what you are left with at the very bottom line is your net income.
Exactly. The sources highlight a critical performance indicator here, the margin. The margin is just your net income expressed as a percentage of your net revenue.
So it tells you exactly how many cents on every single dollar of revenue actually survive to become profit.
Yes. Going back to our terrifying hook from the CBO, when they projected that 60% of hospitals would have negative margins by 2025, it means their operating expenses are completely swallowing their net revenue.
They're spending more to provide the care than they are realistically collecting for it.
Precisely.
But I have to challenge something here, though.
Okay, what's up?
We have the income statement. It tells us our revenue, our expenses, and our final net income. If the income statement already tells us our profit, why do we need a completely separate statement of cash flows?
That's a great question.
Because if I am profitable on paper, doesn't that inherently mean I can pay my bills?
Mm-hmm.
Can a hospital actually be highly profitable but still run out of money to pay the electric bill?
They absolutely can, and sadly, many have. That paradox is the exact reason the cash flow statement is mandatory.
It just seems so counterintuitive.
You can show a massive profit on your income statement, but have literally zero cash in your bank account to make payroll that week.
How is that even possible? Where's all the money?
It is tied up in the timing. GAAP accounting utilizes accrual accounting. It records revenue when a service is provided, not when the cash actually hits the bank account.
Oh, wow.
So if your hospital performs 36 highly lucrative elective surgeries in December, your December income statement will look incredibly profitable. You rendered the services, you earned the revenue.
Well, you're dealing with insurance companies.
Exactly. They might take 60 or 90 days to process the claims. If those checks do not arrive until March, you have zero actual cash in January to pay the nurses who perform those surgeries.
That's terrifying. So the income statement video shows you running a great race, but the cash flow oxygen monitor shows you are actually suffocating right now.
Yes, exactly. The cash flow statement strips away the accrual accounting illusions. It explains the precise changes in your actual cash position over the period.
And the sources categorize this cash movement into 3 buckets, right? Operating, investing, and financing.
Yes. Let's break those down. Cash from operations is the vital one. This is the literal cash generated and used to fund your core business, which is providing patient care.
Okay, what about investing?
Cash from investing tracks, cash deployed for things like buying new equipment or generating interest income, and cash from financing deals with the capital structure, so cash borrowed from banks and loans repaid.
Why do we even separate them, though? I mean, cash is cash, right? Does it matter where it comes from?
Oh, it matters immensely, because the source of the cash tells you if the business is dying.
Wait, really?
Think about it. If your core business activities, your operations, are not generating enough cash to sustain the hospital, and you are constantly relying on newly borrowed cash from the financing section just to make payroll, the cash flow statement exposes that fatal flaw immediately.
Because you cannot borrow your way to long-term survival. Eventually, the banks stop lending. Okay, so that is the macro view. That is what the CEO and the CFO are stressing over in the C-suite. But if our listener is a department head running a specific clinical unit, they aren't looking at the hospital's consolidated cash flow statement every Tuesday.
No, they're looking at something much more granular, the departmental operating report.
Right, and departmental reports take the massive hospital-wide expenses and revenues and just break them down to the individual cost center, like your specific ICU or your specific outpatient clinic.
And the primary function of this report for a clinical leader is to analyze variances. You compare what you budgeted to happen against what actually happened.
Let's create a scenario out of the example provided in the sources, because this is really where theoretical accounting meets the day-to-day reality of a nursing leader.
Let's do it.
Let's walk through the math on a payroll variance.
Okay, imagine you receive your departmental operating report for the month of October. During your budget planning a year ago, you projected you would have 450 patient days in October.
Standard month.
But reality was different. You actually had a crazy busy month with 500 patient days.
So surge in volume. 50 extra days of patient care.
Right. Now look at the payroll dollars attached to that. Your budget said you were allowed to spend $209,854 on payroll for the month, but your actual payroll expense came in at $249,854.
Yikes. So you have a total variance of $40,000 over budget.
Yeah.
You spent 40 grand more than you were given.
Yes.
If I'm the DNP, my stomach drops.
Okay.
The CFO is absolutely going to send an email asking why I blew past my budget by $40,000.
They absolutely will, and they'll want answers fast. And as a leader, you cannot simply wave your hands and say, well, we have more patients, we were busy.
So that's an excuse, not an explanation.
Exactly. You have to prove the variance with mathematics. You have to dissect that $40,000. How much of that overage is purely mathematically justified by the fact that you had 50 extra patient days?
We have to isolate the variables. So let's do the math the text lays out. First, we find out what our expected efficiency was. We take our budgeted payroll of $209,854 and divide it by our budgeted 450 patient days. And that gives us a budgeted cost per patient day of exactly $466.34.
So that was your target efficiency rate. Every patient day should cost you $466.34 in payroll.
Okay, so we take that target of $466.34 and we multiply it by the 50 extra patient days we actually experience.
Yeah.
That equals $23,372.
There's your volume variance. So now you can confidently reply to the CFO and say, of the $40,000 total variance, $23,317 is entirely justified by our pure volume increase. We maintained our exact budgeted efficiency while treating 50 extra patients.
Phew. So the math shields me for the first $23,000. But wait, the total overage was $40,000.
Okay.
If I subtract the $23,317 that it just mathematically justified based on volume, I was still left with $16,683 totally unaccounted for. I spent an extra $16,000 that has absolutely nothing to do with how many patients we saw.
And that is the true moment of truth for a department leader. The math has isolated the operational problem. How do you explain the remaining $16,683?
I have to dig into the clinical realities of that specific month.
Precisely. Was there a massive spike in patient acuity? Did those 50 extra patients require a more intensive skill mix of nurses, driving up the hourly rate?
Or did you have a flu outbreak among your staff that forced you to mandate time and a half overtime to cover shifts?
Or maybe you had to rely on expensive external agency nurses.
Right. You use the math to separate the good variance, costs that naturally rise when you successfully treat more people, from the bad or unexplained variance. It forces you to stop guessing and start actually managing.
It changes a defensive, apologetic conversation with finance into a proactive, data-driven strategy session. You identify the $16,000 problem, and you present an action plan to manage the acuity mix or reduce agency reliance for the next month.
That brings us to a really fascinating pivot. We've looked at the big statements and we've done the granular variance math. But executives overseeing 10 different hospitals don't have the time to do deep variance math on every single line item every single day.
No, they'd never sleep.
So to keep a pulse on the massive machine, they use shortcuts, the financial cheat codes.
The formal term is financial ratios and performance metrics. Ratios are simply the mathematical comparison of two numbers from the financial statements.
And on their own, they are just numbers, right?
Yeah, they only become valuable when they are tracked over time to spot trends, or when they are benchmarked against state, regional, and national industry averages. We can group the most critical ones into three main categories: liquidity, profitability and efficiency, and cash indicators.
Let's start with the liquidity ratios. These answer a very simple question. Can the organization meet its obligations over the next year? Can we pay our near-term bills?
The baseline metric here is the current ratio,
which is calculated by taking current assets and dividing them by current liabilities.
Generally speaking, a higher current ratio is favorable. If your ratio is 2.0, it means you have $2 of current assets for every $1 of current debt. You are safe.
But if we recall our earlier discussion about the balance sheet, you have to be incredibly careful relying solely on the current ratio, don't you?
Very careful. What did we say was included in current assets?
Inventory. The massive supply closets full of bed sheets, bandages, and tongue depressors.
Exactly. The current ratio treats inventory as equal to cash. But if a pharmaceutical supplier suddenly demands payment on a short-term invoice or a bank calls in a loan, you cannot hand them a pallet of bed sheets.
You literally can't pay the electric bill with medical supplies.
Which is why financial leaders, when they really want to know if they can survive an immediate cash crunch, prefer the quick ratio, which is also ominously known as the acid test.
The acid test. I love that. How is it different from the current ratio?
The formula for the quick ratio is current assets minus inventories divided by current liabilities.
Oh, I see.
By stripping the inventory out of the numerator entirely, it becomes a much more stringent, unforgiving measure of true, immediate liquidity. It tells you exactly how many dollars of highly liquid, easily accessible assets you have per dollar of current debt.
It strips away the illusion of wealth tied up in physical supplies.
That's so smart. Okay, moving to the second category, profitability and efficiency ratios. We've already discussed the total margin, which measures how much net income is generated from total revenue. Another major metric executives look at is return on assets, or ROA.
ROA is calculated by dividing net income by total assets, right?
Yes, this ratio tells investors or board members how effectively the management team is actually utilizing the organization's massive physical resources to produce income.
Let's put a scenario to that. If two competing hospitals across town both have $100 million in total assets, buildings, machines, land, but Hospital A generates $5 million in profit at the end of the year, and Hospital B generates $10 million in profit, Hospital B has a vastly superior return on assets.
Exactly. They are working their machinery and their real estate twice as efficiently.
But healthcare is human. We aren't just factories. How do we measure the operational efficiency of the human side of the hospital?
We look at volume metrics like the average daily census. This is the average number of inpatients treated during a given period. It is the core measure of inpatient volume.
And the sources make a really fundamental point about the average daily census. A higher census is inherently structurally beneficial for profitability
Why is that?
because of the nature of fixed costs. If you are paying to heat the building, keep the lights on, and staff the security guards at the entrances, those costs are exactly the same whether you have 10 patients in beds or 100 patients in beds.
Right.
But when you have 100 patients, that fixed cost per patient drops dramatically.
You are leveraging your fixed infrastructure. A hospital is a massive fixed cost engine. The more volume you push through it, the more efficient it naturally becomes.
Makes total sense.
Closely related to this is the inpatient bed occupancy rate. You take the actual number of beds occupied and divide it by the total number of available beds. This gauges the critical balance between the community's demand for care and your hospital's available resources.
The third bucket of ratios deals with cash indicators. We know cash is oxygen. The first metric here is days cash on hand.
Days cash on hand measures how many literal days the organization could continue to pay its daily cash obligations, keeping the lights on, paying staff, if all new cash resources suddenly completely stopped.
Like, if no more checks arrived, how long until we shut down?
Exactly. Higher values obviously implied higher safety and liquidity, but there is a strategic catch to this metric.
What is the downside of having too much cash? I mean, if I'm the CFO, I want a mountain of cash.
You might think so, but organizations shouldn't hold massive, excessive amounts of cash in short-term, low-yield accounts.
Why not?
Because cash sitting still actively loses value to inflation. A dollar today buys less next year. If you have 300 days of cash sitting in a checking account, you are wasting the earning potential of that capital.
Oh, because it's just stagnating.
Right. It provides a drastically lower return than if you had taken that excess cash and invested it into long-term strategic projects or higher yield investments.
It's a real tightrope walk. You need enough days on hand to survive an unexpected crisis, but not so much that inflation is eating your assets alive.
Precisely.
The next cash indicator is days in accounts receivable, or days in AR. This measures the average time it takes an organization to actually collect the money it is owed from insurers and patients after the service is rendered. And I have an analogy for this one that makes it instantly understandable.
Oh, go for it.
Days in AR is basically tracking how long your friend takes to Venmo you back after you paid for dinner.
That's a great way to think of it.
Right. If you put down your credit card and they Venmo you your half before you even leave the restaurant, your days in AR is 0. You are completely liquid.
Perfect scenario.
But if they take 3 weeks to Venmo you, you are out that cash in the meantime. The longer it takes them to pay you back, the higher your carrying cost. You might not be able to buy groceries on Tuesday because your own money is tied up in your friend's delay.
Exactly.
For a hospital dealing in millions of dollars, a shorter collection period dramatically lowers the dollar amount of receivables, which frees up cash and lowers their carrying cost.
That is a perfect translation. A hospital with 40 days in AR is vastly healthier and more agile than a hospital with 90 days in AR, even if their theoretical revenue on the income statement is identical.
Because the hospital with 90 days in AR is gasping for oxygen while waiting for the Venmo notification from the insurance company.
Yes, exactly. And the final indicator the sources give us ties right back to the balance sheet deductions we explored earlier, the paid claims ratio.
The paid claims ratio is brutally simple. It measures what the hospital bills versus what they actually collect. It basically answers the fundamental question. For every dollar we bill, how many cents do we actually get?
Right. If we bill $1, do we get 40 cents, 60 cents?
It tells the executive team exactly how devastating those contractual allowances and bad debts actually are to the bottom line.
When you step back and look at all these ratios together, liquidity, profitability, cash flow, they give a leader a comprehensive dashboard of the hospital's present health.
But leadership isn't just about managing today.
No, it's not. Once you understand the present, you are obligated to start planning for the future. You have to ask, How do we deploy our resources to build out new services, improve care, and expand our system?
Which brings us to the most complex part of our journey today, capital budgeting. We've talked about how to measure the hospital's health today. But what if those metrics are telling you that you actually need to grow to survive?
Then you need capital.
Right. How do you actually get the money to build a new ER without destroying the balance sheet we just learned about? That requires a totally different framework. According to the sources, capital budgeting is the formal process for making these massive long-term investments.
These are monumental decisions because they lock up the organization's capital for years, sometimes decades. You don't just build a new clinic on a whim.
Obviously not.
The budgets for these massive capital projects are derived from deep strategic initiatives, environmental evaluations, and rigorous SWOT analyses. You are not guessing at the future, you are attempting to build a mathematical model of it.
And the primary tool used to build that model is the pro forma.
Yes.
A pro forma. What exactly is it, and how is it different from the financial statements we've already looked at?
Well, a pro forma is a forward-looking financial document used to model and predict future operational performance based on a series of carefully constructed business assumptions.
Okay, so it's a projection.
Exactly. It essentially builds a series of hypothetical future balance sheets and cash flow statements for the proposed project. If you want to build a new ER, the pro forma will project exactly what the ER's finances will look like in year 1, year 2, all the way to year 5.
And there is a critical distinction here that we really need to highlight. We spent a lot of time talking about GAAP, the generally accepted accounting principles, but a pro forma is absolutely not restricted by GAAP standards, is it?
No, it is not.
Why not?
Think about the purpose of the document. GAAP exists as a rear-view mirror. It is designed to rigorously report what has already happened to outside entities like investors and regulators, to prevent fraud and ensure standardized reporting.
Okay, so GAAP is strictly historical.
Right. A pro forma is a windshield. It is looking forward. It is an internal tool developed independently by the organization to guide executive risk-taking and decision-making.
So you have a lot more freedom.
Yes, you are allowed to structure the pro forma in whatever way best helps you accurately assess the future contribution margin of the project. But because it isn't bound by strict rules, the assumptions you build it on must stand up to fierce, skeptical scrutiny by decision makers.
When a hospital board or a CFO is looking through that windshield at a pro forma, how do they actually evaluate it? Because the sources outline a specific methodology called the 3F framework for project evaluation.
Finances, fit, and feasibility. Every single major capital project must pass through all 3 of those filters.
Let's break those down. First is finances. This is the return on investment, the ROI. Do the numbers make mathematical sense? Does the project actually generate wealth?
We are going to get deep into the heavy math of that in just a moment.
Yeah, we are. But the second F is fit. What does that mean?
Fit is about strategic alignment. Every prospective project must be evaluated for how well it fits with the strategic outcomes, the mission, and the broad organizational frameworks of the hospital.
I'm going to push on this. Can a fit actually override finances? Let's say a project has a massive, guaranteed financial return. I mean, it will literally print money. But it doesn't quite fit the mission. What happens?
If the organization has integrity, it must absolutely be rejected.
Wow, really?
Yes. The sources explicitly state that projects with highly positive financial returns may frequently be rejected due to a lack of alignment. The scarcity of resources dictates that companies must focus exclusively on living their mission and realizing their vision.
Give me an example of that in the real world. I need to visualize this.
Sure. Imagine an inner-city safety net hospital whose core mission is serving a disadvantaged, underinsured urban population.
Okay, so a very specific community mission.
A private developer approaches them to partner on building a luxury, high-end cosmetic surgery wing. The pro forma shows that the project will generate millions of dollars in pure profit within 3 years. The finances are spectacular.
But the fit is disastrous.
Exactly. It diverts focus, space, and executive energy away from the core mission. They must reject it.
That makes perfect sense. So you have finances and fit. The third F is feasibility. This is basically the reality check on your ambition, right?
Yes, it asks, do we actually have the internal financial and human resources available to pull this off? Is there true market viability? What is the opportunity cost?
And to accurately assess both the finances and the feasibility of a project, the CFO has to follow strict, unforgiving rules for forecasting the cash flows of the project.
Yeah.
You cannot just throw optimistic numbers onto a spreadsheet.
You really can't. The rules are strict.
The sources list several forecasting rules. Rule 1, Only consider incremental cash flows. Rule 2, use after-tax cash flows. Rule 3, include all firm-wide impacts.
Firm-wide impacts is a big one.
Let's explore that. Let's say our hypothetical hospital builds a shiny new urgent care clinic across town. But in doing so, it steals patients away from the hospital's own emergency room. We have to account for that lost ER revenue in the urgent care's pro forma, right?
Exactly. You cannot cannibalize your own business and call it new revenue.
Makes sense. Rule 4, you must include opportunity costs. So if you own a vacant lot and decide to use it to build that clinic, you lose the opportunity to sell that land to a developer.
Right. And the potential cash from that lost sale must be factored in as a cost of the project.
Rule 5, do not allocate existing overhead costs. So if the hospital's current HR department is going to handle the hiring for the new clinic without actually adding any new HR staff, you don't charge the new clinic for a portion of the existing HR salaries.
Correct, because it doesn't reflect a new incremental cash outflow.
And then there is Rule 6. This is the big one. Ignore sunk costs. This rule fascinates me because it goes against every natural human instinct.
It's so hard for people to grasp.
The rule states that money you have already spent in the past cannot, under any circumstances, factor into your forecast for the future. Why is human psychology so obsessed with sunk costs? And why is that obsession so fatal in capital budgeting?
It is rooted in cognitive dissonance and loss aversion. We deeply hate the idea of wasting money. Think of it like an old, broken-down car.
Yeah.
You just spent $2,000 replacing the transmission. A week later, the engine blows. Human nature screams, I can't junk the car now, I just put $2,000 into it. If I junk it, I wasted that money.
So you spend another $3,000 on an engine.
Right, but the financial reality is that the $2,000 is gone regardless of what you do. It is a sunk cost.
So it shouldn't dictate your next move.
Precisely. If a hospital spends $5 million researching a new proprietary software system, and halfway through development they realize a better, cheaper system was just released commercially, executives will fight to finish their proprietary system just to save the $5 million investment.
But if they spend another $5 million to finish an obsolete project, they haven't saved the first $5 million. They have just actively wasted a total of $10 million.
Exactly. In capital budgeting, you must act ruthlessly based only on what the future cash flows will be, completely independent of past mistakes or expenditures.
If we are forced to look strictly at the future to make these massive financial decisions, we have to understand the fundamental law of the financial universe that governs that future.
The time value of money.
Yes. This is the core concept that everything else is built upon. The time value of money.
It is the bedrock of all finance. The principle is very simple. $1 today is worth intrinsically more than $1 tomorrow.
But why? I mean, if I hold a crisp $1 bill in my hand today, and I hold that exact same piece of paper a year from now, why is it suddenly less valuable?
The sources outline 4 primary reasons for this. First, inherent risk. The future is uncertain. The entity that promised to give you the dollar next year might go bankrupt. A dollar in your hand today is guaranteed.
Okay, risk makes sense.
Second, inflationary forces. Prices naturally go up over time, meaning next year's dollar will buy less bread or fewer medical supplies than today's dollar.
That's inflation was third.
Third, broader macroeconomic factors and market shifts. And fourth, present buying power and opportunity cost.
Opportunity cost meaning if I have the dollar today, I can use it to make more dollars.
Exactly. If you have the dollar today, you can invest it in an interest-bearing account or a profitable project today. By next year, it will have grown to $1.10.
So any monetary amount has higher earning potential in the present than in the future.
That's the core idea.
This concept seems intuitive, but it leads directly into what I call the $1,000 trap. One of the finance lectures in our sources lays out a brilliant, highly deceptive example of how ignoring the time value of money will lead you to make disastrous business decisions. Let's walk through it together.
All right, let's do it. Let's say you were presented with an investment opportunity. You must invest $1,000 in cash today.
Okay, $1,000 out of my pocket.
In return, the project promises to pay you $800 exactly 1 year from now and another $800 exactly 2 years from now. The core question is this a mathematically sound investment?
And the simple math in my head immediately fires up and says, well, 800 plus 800 is 1,600. I put in 1,000, and over 2 years, I get back 1,600. That is a $600 pure profit. Yes, absolutely is a great investment.
And as the lecture points out, that thought process is a catastrophic fundamental error. It is completely flawed.
But the numbers add up. I mean, $1,600 is greater than $1,000. Why is it flawed?
Because you are committing a mathematical sin. You are adding numbers from different time periods together as if they possess the same weight.
Oh, I see. It's like measuring distance. You can't just take 5 miles and 5 kilometers, add them together, and confidently tell someone they have to walk 10.
10, what? The units don't match.
Exactly. You have to convert them to the exact same metric first before you could do any math. Here, the mismatch metric isn't distance, it's time. We have to bring everything back to today dollars.
That is the exact conceptual leap you have to make. You cannot add the first $800, which carries the degraded value of 1 year in the future, to the second $800, which carries the even more degraded value of 2 years in the future.
Because they possess completely different weights of actual buying power.
Yes.
So, if we can't just add them up, what is the mathematical solution? How do we actually evaluate the investment?
We must discount those future payments. We calculate the present value of those future cash flows.
Just count them.
Yeah, we use a formula to essentially run inflation, risk, and opportunity cost in reverse to strip away the illusion of time. We figure out what those future $800 payments are actually literally worth in today's money.
And only after we have converted everything into present value can we compare them to our initial $1,000 investment.
Precisely.
Knowing that we can never rely on simple addition. How do hospital CFOs actually make these multi-million-dollar choices when faced with complex projects? This takes us to the mathematical frameworks.
Right, the 3 approaches.
The sources lay out 3 primary approaches to making investment decisions. Let's set up the scenario the text provides.
Okay, management must choose the best project between 2 competing options. Project A requires an initial capital investment of $42,000. In return, it guarantees a steady, reliable cash inflow of $13,000 a year for the next 5 years.
So $42K out on day 1 and $14K a year back for 5 years. What about Project B?
Project B requires a slightly higher initial investment of $45,000, but its returns are front-loaded and variable. In year 1, it returns a massive $28,000. Year 2 drops to $12,000, and years 3, 4, and 5 dwindle to $10,000 each.
We have 2 projects, different costs, totally different cash flows. The first approach to figuring out which one wins is extremely simple. It's called the payback method. How does it work?
The payback method ignores all complex math and simply asks, how long will it take for you to recover your initial investment?
Just break-even time.
Right. For Project A, your initial investment is $42,000. You get $14,000 a year. 14,000 times 3 equals 42,000. So Project A takes exactly 3 years to reach its payback period. Simple enough. What about Project B?
Project B's investment is $45,000. In year 1, you get $28,000. In year 2, you get $12,000. That totals $40,000 in just 2 years.
Okay, so you need $5,000 more.
You only need $5,000 more to recover your $45K, and year 3 gives you $10,000. So it will take roughly 2.5 years to recover the initial investment.
So under the payback method, Project B is the clear winner because it gets your money back into the hospital's bank account faster. But hold on.
Yeah.
This approach just added the year 1 $28,000 directly to the year 2 $12,000. It committed the exact mathematical sin we just talked about. It completely ignores the time value of money.
It absolutely does. It treats a year $3 exactly the same as a year $1. It is widely criticized by financial theorists for this exact reason. It is mathematically blind to value.
So if it is mathematically flawed, why on earth is it still one of the most popular methods actively used by major corporations today?
Because of absolute ruthless practicality. Theory is nice, but survival is mandatory.
Imagine your hospital borrows $300,000 from a commercial bank to fund a project, and the bank gives you a strict 4-year term on the loan. Your payback period simply cannot be longer than 4 years.
Oh, because if it is, you default.
Exactly. It does not matter how incredibly high the complex present value of the year 5 cash flows might be. If you can't pay the bank back in year 4, you default, and the bank seizes the asset. The payback method is a blunt instrument, a survival filter, used to ensure short-term liquidity.
It doesn't tell you if the project is a great idea. It just tells you if it will bankrupt you in the short term.
That's a perfect summary.
But if we want the actual mathematically correct answer that fully respects the time value of money, we have to move to approach number 2, net present value, or NPV.
NPV is the unquestioned gold standard of corporate finance. To calculate it, you must find the true present value of all expected future cash inflows.
So we discount everything back.
Yes, you take every single future payment and discount it back to today's dollars. But to do that, you have to use a specific interest rate known as a discount rate.
Now, I've heard this called the hurdle rate, or the WACC, the weighted average cost of capital. But before we go further, if I'm a nursing director trying to get a new MRI machine, What does WACC actually mean in plain English? Explain it to me like I'm 5.
Okay, think of the hospital's total pool of money like a giant blender.
A blender.
A blender. The hospital gets money to build things from different sources. Some money comes from bank loans that charge 5% interest. Some comes from issuing municipal bonds that pay out 7% interest.
Okay, so different costs for different money.
The WACC is simply the blended average of what it costs the hospital just to possess all that money in the blender. Let's say the blended cost is 6%. That is your hurdle rate.
Oh, I see.
If your MRI machine project does not earn a return higher than that 6% blended cost, you are actively destroying value. You are paying more for the money than the machine is earning.
Okay, that makes perfect sense. So we use that blended cost, that discount rate, to shrink all the future cash flows down to their true present value.
Yeah.
Then we add all those discounted inflows together. And finally, we subtract our initial cash cost to launch the project.
The sources note that trying to do this complex discounting by hand with actuarial tables is incredibly tedious. In the real world, finance departments just use software.
Right, like Excel.
In Excel, the formula is shockingly simple. Equals NPV, parenthesis, rate, comma, values, close parenthesis, minus initial investment. You input your discount rate, highlight your column of future cash inflows, and subtract your initial outflow.
What is the rule for deciding whether to accept a project based on NPV?
The decision rule is absolute. If the NPV is greater than 0, you accept the project.
Anything over 0.
Yes, because an NPV of just $1 means the project is covering its initial cost, covering the blended cost of capital, and creating $1 of pure real wealth in today's terms.
Okay, but what if I have 2 options?
If you are choosing between mutually exclusive projects like Project A and Project B, you simply pick the one with the highest positive NPV.
When the lecturer in our sources runs the NPV calculation for our 2 projects, assuming a 10% discount rate, Project A actually wins. Even though Project B paid back faster, Project A's steady $14,000 over 5 years creates a higher total present value.
Exactly. NPV found the real value.
But there's a massive vulnerability hidden inside NPV, isn't there? It is wildly sensitive to the discount rate you choose to punch into the formula.
This is a vital concept for any leader to understand. Let's return to your $1,000 trap example.
1,000 out, 800 back in year 1, 800 back in year 2.
Right. If our discount rate is normal, stable 10%, the NPV calculation shows this is an excellent investment. The present value of those 2 $800 payments easily clears the $1,000 initial cost.
Right.
But the lecturer asks a profound question. What if the interest rate in the economy spikes to 40%?
Oh, wow. If the rate is 40%, it means inflation is catastrophic or borrowing costs have skyrocketed. The money we get in the future becomes nearly worthless because it loses buying power so fast.
Precisely. And when the instructor runs that exact same Excel formula but changes the rate to 40%, the NPV collapses. It becomes a negative 20.
So just by changing the assumption of what the economy will do, the exact same project transforms from a moneymaker into a mathematical disaster.
It reveals the fragile nature of financial modeling. Your net present value is only as accurate and reliable as your forecasted discount rate.
So we have NPV, which gives us a raw dollar amount of wealth created. But there is a third approach executives look at, the internal rate of return, or IRR.
IRR flips the entire NPV equation around.
How so?
Instead of giving you a dollar amount, IRR calculates the exact specific discount rate at which your expected cash inflows perfectly equal your cash outflows. In mathematical terms, IRR is the exact interest rate that forces your NPV to hit exactly 0.
So it basically gives you a percentage.
Yes. The Excel formula is simply equals IRR parentheses values. You highlight all cash flows starting with the negative initial investment in year 0. If you run this for Project B, the Excel calculation spits out approximately 22%.
So if my project have an IRR of 22%, how do I know if I should pitch it to the board?
You compare that 22% to your hurdle rate, your WACC.
The blended cost of money.
Right. If it costs the hospital 10% to blend their money, and your project generates an internal return of 22%, you aggressively champion the project. The project is working significantly harder than the cost of your money.
I want to clarify a potential conflict here, though.
Sure.
If NPV gives me a raw dollar amount of total wealth created, and IRR gives me a percentage grade on how aggressively my money's working.
Yeah.
Do these 2 formulas ever disagree on which project is actually better?
They absolutely can, and they frequently do, especially when projects have drastically different initial sizes or different timing of cash flows.
Give me an example.
You might evaluate a small project that has a massive IRR percentage, but a huge capital-intensive project with a lower IRR might ultimately generate millions of dollars more in actual absolute NPV.
So when they disagree, which one wins the argument in the boardroom?
The sources are definitive on this. If given a choice between the two methods, any valuation method producing results that differ from NPV is incorrect.
Always defer to NPV.
You must always defer to net present value. Why? Because NPV measures absolute value creation in today's literal dollars. It tells you exactly how much the enterprise value of the hospital will increase. Executives often love IRR because it is highly intuitive. People naturally understand percentage returns. But NPV is the mathematical truth.
As a clinical leader, as the DNP listening to this right now, you might be thinking, I am never going to sit at a computer and type equals NPV into an Excel spreadsheet. The CFO's analysts do that.
They probably will.
So why does the clinical leader need to understand the sensitivity of this math?
Because the CFO's spreadsheet is entirely dependent on your clinical inputs.
What do you mean?
Who tells the CFO how many patients that new MRI machine will scan a day? You do. Who tells them what the average billing charge will be? You do.
Oh, what?
If you artificially inflate your expected patient volume just to get your project approved, you are inflating the future cash inflows on their pro forma. The CFO runs the NPV based on your optimistic numbers, the project looks highly profitable, and they write the check.
But 2 years later.
But 2 years later, when your volume falls short of your promises, the real-world NPV turns negative. The project bleeds money, and you are the one held accountable for destroying the hospital's capital. Understanding how brutally sensitive this math is forces you to be hyper-realistic, conservative, and strategically sound with your clinical projections.
You don't just provide the wish list. You own the financial outcome of the clinical reality.
That's exactly it.
Let's pull all of this together. We've been on a massive journey today.
We really have.
We started at the macro level, learning the dialects of GAAP and how to read the big three statements. We learned the difference between the balance sheet photograph, the income statement video, and the cash flow oxygen monitor.
We learned how to drill down into departmental reports, separating justifiable volume variance from real operational problems.
We moved into the micro-level cheat codes, the ratios executives use to judge liquidity and efficiency. We explored why stripping out inventory is vital for the quick ratio and how Venmo wait times perfectly illustrate the drag of days in accounts receivable.
And finally, we looked through the windshield. We explored how to construct the future using capital budgeting.
We learned that pro formas model out investments, governed by the mission-driven 3F framework of finances, fit, and feasibility. And we cracked open the mathematical tools to evaluate those finances. Understanding the time value of money, escaping the $1,000 trap, utilizing the payback method for raw survival, and ultimately calculating NPV and IRR to find true long-term value.
The ultimate takeaway is that mastering these concepts gives you a seat at the adult table.
I love that phrasing.
You can no longer just argue that a new piece of equipment or a new staffing model will help patients. You have to prove its NPV, you have to explain its impact on your unit's margin, and you have to assure the CFO that your request won't trigger a massive, unplanned depreciation write-down.
It empowers you to protect the clinical mission by guaranteeing the financial viability of the organization.
Exactly.
As we wrap up, I want to leave you with a final thought to ponder. A provocation that builds on the collision of everything we've discussed today. Think back to the balance sheet.
The photograph.
Right. We learned that a massive chunk of a hospital's gross revenue is simply wiped out, legally vaporized, before it ever hits the bank account by contractual allowances. Those pre-negotiated discounts with third-party payers like private insurance and Medicare.
Yes, it is consistently the largest deduction a healthcare organization faces.
Now, merge that reality with what we just learned about capital budgeting. We know that the gold standard tools like NPV and IRR rely entirely on forecasting exact future cash flows over 5, 7, or 10 years.
You literally build a multi-million-dollar pro forma based on what you expect to be paid in year 5.
So ask yourself, how fragile are these mathematically perfect models really? A single policy change in Washington, D.C., a single legislative adjustment to Medicare reimbursement rates in year 2 of your project could instantly and permanently shrink your expected cash inflows.
A stroke of a pen could completely alter the foundational equation of the pro forma.
It could instantly turn a project with a heavily positive NPV into a catastrophic, value-destroying negative one. It highlights a deeply humbling reality for anyone in leadership. While capital budgeting uses incredibly precise math, and we calculate these IRR percentages down to the decimal point, it is ultimately a castle built on the shifting sands of human assumptions and unpredictable government policy.
The math inside the spreadsheet is perfect, but the future it is trying to predict is never guaranteed.
A profound reminder that true financial leadership requires not just mathematical skill, but relentless strategic vigilance. Keep looking through the windshield. We'll see you on the next deep dive.